These are the only ETFs that you need to know about. I've gone through every major category and narrowed it down to my best picks: S&P 500, All World, Growth, and Dividends. For each one, I will tell you exactly which is the best fund to buy, how much it costs, and the best alternatives for CPF and SRS. And at the end, I will also break down exactly which combination I will pick depending on your situation. Let's get straight into it. Starting with the most popular category, the S&P 500 ETF. The S&P 500 ETF tracks the top 500 companies listed in the US. These are the names like Apple, Microsoft, Amazon, Nvidia. Now, my top pick here is SPYL, or the State Street Spider S&P 500 ETF, which is listed on the London Stock Exchange. It has a total expense ratio of just 0.03%, which makes it the cheapest S&P 500 ETF in the world right now. For context, CSPS, which used to be my go-to recommendation, charges 0.07%, so SPYL is less than half the cost. SPYL is also an accumulating ETF, which means dividends are automatically reinvested back into the fund. Now, you might be wondering, why not just buy WRO? After all, WRO is the Vanguard S&P 500 ETF listed in the US, has the same 0.03% expense ratio, and is also one of the most popular ETFs in the world. But the problem is, WRO is US domiciled. That means you pay 30% withholding tax on dividends, and when you pass away, your estate could be hit with US estate tax of up to 40%. Meanwhile, SPYL is Ireland domiciled, so you only pay 15% withholding tax on dividends. Over a 20 to 30 year investing horizon, those savings would compound into real money. Plus, it doesn't have any estate tax issue, so that's great. The best broker to buy SPYL is Interactive Brokers. That's because the commission for the UK listed ETFs is extremely low at just $1.70 per trade. If you don't have an IBKR account yet, you can sign up via my link here. Then all you have to do is log into IBKR, search for SPYL, tap on the one that says LSE ETF, that stands for London Stock Exchange ETF, hit buy, fill in the details, select to confirm, and you are done. But what about CPF? If you want to invest your CPF OA money into a US index fund, you can look at the Amuni Prime USA Fund. It has a management fee of just 0.05%. I would recommend buying it through Poems, because Poems doesn't charge any fee for buying this fund. If you're not sure how to set this up, I made a step-by-step tutorial that walks you through the whole process, so I will link that here. Warren Buffett himself has said that for most people, a low-cost S&P 500 index fund is all you need, and for good reason. Historically, the S&P 500 has returned an average of about 10% a year over the long run. It has been battle tested through wars, financial crises, and pandemics. So if you just want one simple low-cost fund that gives you exposure to the US market, this is it. But of course, the S&P 500 does come with some risk. The first one is concentration risk. The Magnificent Seven, that's Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, now make up over a third of the entire index. So even though you are technically buying 500 companies, your returns are heavily tied to just a handful of tech stocks. If big tech has a bad year, your portfolio would take a hit too. Second, geographical risk. The S&P 500 only covers US companies. So you are making a bet that the US will continue to outperform the rest of the world. And while that's been true for the past few decades, it hasn't always been the case. There have been entire decades where international markets outperform the US, which brings us to the next category, all-world ETFs. If you don't want to put all your eggs in the US basket, an all-world ETF would give you exposure to companies across the world in a single fund. My top pick here is ACWD, the State Street Spider MSCI All-Country World UCITS ETF. It has a total expense ratio of just 0.12%, which makes it significantly cheaper than the two ETFs I used to talk about, WRA, which charges 0.22%, and FWRA, which charges 0.15%. So ACWD undercuts both of them. That said, there's one difference worth mentioning. ACWD tracks the MSCI All-Country World Index, which hosts around 2,300 stocks. Meanwhile, WRA and FWRA track the FTSE All-World Index, which hosts around 4,000 stocks, because it includes more small-cap companies. But for most investors, this doesn't really matter, because both indexes have performed almost identically over time. So you are getting broad global diversification either way. Also, ACWD is an accumulating ETF, so dividends get reinvested automatically. It's Ireland-domiciled, which means you only pay 15% withholding tax on US dividends instead of the full 30%. Plus, it's listed on the London Stock Exchange, so you can again buy it through interactive brokers. For CPF, the best option is the Amundi Index MSCI World Fund, which you can buy through Poems. It has a management fee of 0.1%. Now, this fund tracks the MSCI World Index, which only covers developed markets. So it doesn't include emerging markets like China, India, or Brazil. But in practice, emerging markets only make up about 12% of a global index, and both funds have performed almost identically over time. So for most investors, this fund will do the job just fine. As for SRS, you can also invest in the Amundi MSCI World Fund through Poems. But if you are worried now about the fees, you can actually buy the IZ ETF through StashAway ETF Explorer for just $1 per trade. IZ has a slightly higher expense ratio at 0.2% as compared to Amundi's 0.1%. But here's the thing, IZ is Ireland-domiciled, so you only pay 15% withholding tax on dividends. The Amundi fund, on the other hand, is Luxembourg-domiciled, which means 30% withholding tax. So when you factor in the tax savings, IZ actually ends up being the cheaper option in the long run. Then you might ask, should I go with the S&P 500 or an all-world fund? Historically, the S&P 500 has outperformed by about 2 percentage points per year. But that gap has largely been driven by US tech stocks over the past decade. Meanwhile, an all-world fund still gives you around 62% US exposure, but you also get the remaining 38% spread across Europe, Asia, and emerging markets. Which means, if you want diversification gao without guessing which country wins next, the all-world is the way to go. Now, what if the S&P 500 isn't aggressive enough for you? That's where US growth ETFs come in. You are essentially saying, hey, let's just invest in the fastest growing companies in the US. Think of tech, innovation, and companies scaling fast. These tend to be more volatile, of course, but they also have higher return potential. For this, one of the most popular options would be QQM, also known as the Invesco Nasdaq 100 ETF, which charges just 0.15% expense ratio. This ETF tracks the top 100 non-financial companies listed on the Nasdaq. So you are getting heavy exposure to names like Apple, Nvidia, Microsoft, and Meta. However, one drawback of QQM is that it only covers companies listed on the Nasdaq. So you miss out on growth names like Visa, Eli Lilly, and United Health, which are listed on the New York Stock Exchange. If you want a more complete picture of US growth, that's where SCSG comes in. The short US large cap growth ETF charges just 0.04%, and its selection criteria is much more deliberate. While QQM simply takes the top 100 companies on the Nasdaq by market cap, SCSG actually screens for growth characteristics like projected earnings growth, price to book ratio, and revenue growth. So it's not just picking the biggest companies, it's also picking the ones that are actually growing the fastest. In terms of performance, over the past 10 years, QQQ has averaged about 20% per year, while SCSG has averaged about 18%. And that's because of their holdings. In terms of sector breakdown, QQM is much more heavily weighted toward technology, while SCSG gives you more exposure to other sectors like healthcare, financials, and industrials. So with SCSG, you're not just betting on tech, you're also getting a broader slice of US growth across multiple sectors, ones that could hold up better if tech ever pulls back. But with that being said, for Singaporean investors, there's a problem. These are all US domiciled ETFs, which means you'll be subject to 30% dividend withholding tax and estate tax. So what are some Ireland domiciled alternatives? The first one is CNDX. This is the iShares Nasdaq 100 U6 ETF, which tracks the same Nasdaq 100 index as QQQ. But the only downside is that it has a much higher expense ratio of 0.33% versus QQM, which is just 0.15%. Then you have R1GR, the iShares Russell 1000 Growth U6 ETF. It has a slightly lower expense ratio of 0.18% and tracks the Russell 1000 Growth Index, which includes about 366 large cap US growth stocks, What I like about R1GR is that it's broader than the Nasdaq 100, as it includes growth stocks listed on the New York Stock Exchange as well, like Visa, Eli Lilly, and Home Depot. So you are getting a more diversified growth exposure as compared to just the Nasdaq. As for performance-wise, since this is a new ETF, it doesn't have much performance data yet. But if you look at the IWF ETF, which tracks the same Russell 1000 Growth Index, we can see that its 10-year performance is around 18%, which is pretty much the same as SCSG. But here's the big question. Is the Ireland tax savings worth the higher expense ratio? Check this out. Assuming we invested $10,000 into these 4 ETFs over 20 years, with an average return of 15% per year and a dividend yield of 0.5%, at first glance, the returns look almost the same. But if we switch over to the total drag chart, we can see that CNDX is losing a total of $15,160 to fees. QQM loses $11,345, while SCHG has the lowest total drag at just $7,263. And that's just a one-time $10,000 investment. If you're also investing $1,000 every month, the fee difference becomes much more significant. This means if you purely want the lowest fees, SCHG is your best bet. But if you are also concerned about the estate tax issue, R1GR will give you a good balance between fee savings and estate tax avoidance. For CPF, the closest US growth fund that I could find is the Franklin US Opportunities Fund. It invests in US companies with sustainable growth characteristics, so you are also getting exposure to all the high growth names. Though, the catch is that this fund charges 1% in fees per year through Endowus, and that's on top of the 0.3% Endowus platform fee. So you are looking at about 1.3% in total fees, which is super expensive. But I guess whether that's worth it or not depends on how badly you want growth exposure through your CPF. As for SRS, you can buy QQQ through StashAway ETF Explorer at just $1 per trade. Now, what if you don't want to wait for your stocks to grow? What if you also want cash flowing into your accounts every quarter? That's where dividend ETFs are for. My two main picks here are SCHD and VHYD. SCHD is the short US dividend equity ETF, which focuses on the top 101 high-quality dividend-paying companies in the US. We are talking about names like Coca-Cola, Pfizer, Verizon, companies with long track records of paying consistent dividends. It has a very low expense ratio of just 0.06%. The only drawback is that SCHD is US domiciled, so you are paying 30% withholding tax on every dividend, and your estates could also be subject to US estate tax. For a dividend-focused ETF, that tax threat will hit especially hard because the whole point is the income. Then we have VHYD, the Vanguard FTSE All-World High Dividend Yield UCITS ETF. Unlike SCHD, VHYD is Ireland domiciled, so there's a much lower 15% dividend withholding tax, and there's no estate tax to worry about. This ETF holds over 2,000 companies globally, so your income is spread across multiple countries and sectors, and not just concentrated in the US. Plus, its total expense ratio is also pretty reasonable at 0.29%. But here's the thing, as a Singaporean investor, is it even worth investing in dividend ETFs? That's because the whole point of a dividend ETF is to receive dividends. But now, you are getting tax gao on your dividends. Assuming you have $10,000 in both funds and you contribute $1,000 to it every year, it gives 10% average return and pays a 3% dividend yield. Over 20 years, with SCHD, you will have lost a total of $65,657 just to dividend withholding tax. And while VHYD has a lower 15% dividend withholding tax, you are still losing around $34,360 in fees. To me, that is a very significant amount. And that's why I feel if you want dividends, Singapore ETFs might actually be a better play here. The one great thing about Singapore ETFs is that there's no dividend withholding tax. So you get to keep 100% of it. No 30% tax nonsense, no 15% nonsense. Zero. Plus, Singapore companies are well known for paying generous dividends. The banks alone yield around 4 to 5%. And if you look at Singapore REITs, you are getting some of the highest distribution yields in the world, with relatively low volatility as compared to other markets. For this, the two most popular options are ES3, the Spider Straits Time Index ETF, and G3B, the Amoa STI ETF, which was rebranded from the Nikko AM STI ETF back in 2025. Both ETFs hold the top 30 companies on the Singapore Exchange, so you are getting exposure to some of Singapore's key industries like banking, real estate, telecommunications, and industrials. And they have a dividend yield of around 3.5%, which is quite decent. Right now, ES3 charges 0.28% and G3B charges 0.25%. But honestly, either one is fine, since the expense ratio adjusts every year and they take turns being cheaper. For CPF and SRS, ES3 and G3B are both CPF IS and SRS approved, and you can buy them directly using either POEMS or FSMOne. As for which is better, since POEMS charges 0.08% while FSMOne charges a flat $3.80, if you are trading less than $4,750, POEMS is cheaper. But if you trade more than that, FSMOne becomes cheaper. But here's something to take note. While investing in the Singapore market for dividend stocks is attractive, keep in mind that Singapore market is tiny. It makes up only about 0.3% of the global stock market, and the STI is heavily concentrated in the banking and real estate sector. So if interest rates shift, both sectors will feel it. For example, banks tend to see tighter margins when rates drop, while REITs struggle when rates rise. So no matter which way rates move, your portfolio would be affected. Because of that, you wouldn't want this to be your entire portfolio. Instead, it works best as part of a broader, more diversified portfolio, where you pair it with a global or US exposure to balance out the concentration risk. So there you have it. Those were the best ETFs across 5 categories. Now, if you are not sure where to start, here's how I would think about it. If you are just starting out and you want something simple that's hard to go wrong with, go with an all-world ETF like ACWD. One fund, global diversification, done. But if you're in your 20s or 30s with a higher risk appetite, you can consider adding a growth tilt with SCHG or R1GR alongside your core holding. Or if you want to keep it simple and stick with the proven winner, you can go with SPYL for the S&P 500 ETF. Lowest cost, long track record, and it's hard to argue against it. If you want dividend income, you can start with Singapore ETFs like ES3 or G3B, where you keep 100% of your dividends. Then layer on WHYD if you want global exposure. And if you want to invest your CPF or SRS money, the money funds through POEMS, ES3 or G3B, or Stash Away ETF Explorer are your best options depending on the category. At the end of the day, there's no single best ETF for everyone. It depends on your age, risk tolerance, goals, and whether you are using CPF, SRS, or cash. The most important thing is to pick something, stay consistent, and let time do the heavy lifting. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.